You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, I'm going to jump right into it today. I want to focus and highlight the Ally Invest YouTube channel on this show. On Tuesdays at noon Eastern Time, myself and this week, Lindsay Bell, talk a little bit about the markets and a particular stock each and every week, and I come up with one option strategy. Now, I would suggest that you might want to check that out because we went in a little bit of detail about an ETF this week, the Russell 2000 ETF, the IWM. And we looked at a little strategy based off of that forecast in IWM. Now, as always, nothing is meant to be a recommendation here on Options Playbook Radio or on the Stock Play of the Day. We're just trying to learn. We're trying to apply strategies from the playbook that might set up well in the current marketplace or volatility environment, days to expiration, et cetera, et cetera. So if you'd like a little bit more detail about why I'm thinking about IWM, please go and check out the Ally YouTube channel and look for the playlist for Stock Play of the Day. So on Stock Play of the Day in YouTube, we usually do a little bit more basic strategy. Today, I'm going to go back to a standard. I'm going to talk about a butterfly. I kind of like butterflies in indexes in general, something where you have some volatility, but some predictability, which a lot of people would say is an oxymoron. But in general, you don't see indexes move way outside of a range extremely fast. Now, the Russell 2000 index is one of the faster moving indexes. It's based off of the small cap, and small cap prices are usually a little bit more volatile than large caps in general, i.e. something like the SPY or the S&P 500 index. So we're going to look at IWM today, and based off of what we've seen in the charting, we're going to target a new high in IWM. The Fed met last week, had a decent meeting. The market seemed to accept what the Fed was saying in regards to tapering and inflation and other little things. And the market in the S&P 500 index set a new high. The Russell 2000 has been a little bit of a laggard, but we were at a very focal point in the chart, which is kind of hard to define inside a podcast. So I'm going to send you over and give you a little required viewing, if you will, on the Ally Invest YouTube channel. So the strategy that I'm going to do is I'm going to be targeting the area where the Russell could lead to a new high. And ideally, if we could get the Russell 2000 to a new high, that would be good for the markets overall. The Russell 2000 index, when we were coming back from the first round of the pandemic, led the way to new highs, was actually leading most of even the NASDAQ and the S&P 500 index, leading the whole market higher. Now we see that it's been a laggard, and it was a lot probably because of inflationary concerns that have been a little bit relieved more recently, but inflation is still out there. It's still potential and something that we need to be concerned about a little bit. So with that said, we're a little bit above the middle of the channel. If we looked at a Fibonacci number, we would be about at the 61.8 level. We just kind of broke through that level, hoping that we go to the higher end of the channel. So we're going to do this butterfly. We're going to go 4 points wide. I should mention that we are taping Options Playbook Radio. It's Wednesday, September 1st. The markets are open and rocking and rolling. Right now, my quotes are saying that the IWM is at 227.55. It's up $1.63 right now. And I'm going to actually make that a static quote. I'm going to turn off my real time quotes so that market won't move while we're talking. And we're going to buy the September 17th expiration butterfly. We're going to target a price. So we're going to go out of the money. We're going to be a little bit bullish with this. We're going to buy the 228 strike call. We're going to sell the 232 strike call. And we're going to then buy the 236 strike call. Now, it will be done on a 1x2x1. That is just a one lot butterfly. And right now I'm showing the midpoint. We got very tight markets in the IWM, but the midpoint is pricing at 87 cents. That means for every 1x2x1 butterfly, we're going to pay $87 plus commission to put on that trade. And it is an equal weighted butterfly. In other words, the strikes are 4 points away on the long call spread and on the short call spread. So the maximum that we can lose on that trade is the net debit paid, or 87 cents. And the maximum we can make on that trade would be the width between the strikes, which is 4 points or $400, minus that 87 cents, or basically $3 and we'll call it 13 cents, but you got to worry about commissions overall. Ideally, we're not really going to try to make the maximum on that trade. That means that it would go in 17 days. We'd end up which is that expiration day. Actually, it's 16 days away. We're going to end up right at that 232 strike. That's the only way you really get the maximum on a butterfly. So if we put this on for 88 cents, our risk is 88 cents. If we could take it off, and the butterfly was trading for $1.60 to $2. That's where my target would be on the upside. On the downside, if the market does go against us and goes against us in a hurry, there is an adjustment that can be made. But basically, I would probably say if I see this trading for around 40 cents or even 30 cents, I'd think about getting out on the downside overall. Means the market has basically what we were hoping, the momentum to the upside of the channel or to the new high in the IWM is not happening. And I would just cut my losses and move on that trade. So I think butterflies, let's talk a little bit about that. Butterflies make sense on volatile stocks that are expensive stocks because you can get them done for a fairly cheap price. The higher the volatility, the cheaper the butterfly will be overall. So once I put on the trade, I want implied volatilities to come down, which is good on a bullish trade overall. That would be good for the IWM if the market did go up. And I want time to decay. Butterflies will max out very close to the expiration date. And obviously, you need it to land within your strikes in order to be profitable here. Now, this is an ETF. It is the IWM, which does mean that if you do exercise a call option, you would be buying shares of stock as opposed to the RUT, RUT, which is an index, and that is cash settled. You never buy all the shares in the index. You just are cash settled at expiration. So you would have to trade out of this position. If you were correct on your forecast, more than likely, you'd want to close out your trade on that expiration date. So It's going to be a little bit of a short and sweet options playbook radio here. Well, let's hope it's sweet. Going to emphasize nothing's meant to be a recommendation, but we have the Russell 2000 index right now trading at 227.49. We're going to go a little bit out of the money with a call butterfly. We're going to be buying the 228 strike call, selling 2 of the 232 strike calls, and then buying 1 of the 236 strike calls. This is done for a net debit of 87 cents to the account. That will be our maximum risk. For every 1x2x1 butterfly, we have $87 plus commission of risk. Our upside is $4. That's the maximum it could trade for. So our true upside, if you did make the maximum on that trade, would be $3.13 less commissions on that trade overall. And we'll kind of see what happens here. Now, we picked this 16 days to expiration, mainly because, as I mentioned, butterflies don't really pay you quickly if you're correct on your forecast. So picking your time period is pretty big. You don't want to be too short on the time period because you want to give the market time to move, but you don't want to be too long on your time period with butterflies, because if it does make the move, well, then in that situation, you might not get as much as you were expecting if we go out 32 to 40 days in time overall. So my sweet spot a little bit, especially looking at indexes or ETFs that track indexes, is right around a 2-week period. So in this situation, the September 17th expiration is what we chose. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.